Hello and welcome to Mission Wealth's Market Perspectives for the first quarter of 2020. My name is Kieran Osborne. I'm a partner and the Chief Investment Officer at Mission Wealth. I'm pleased to be presenting to you our outlook on the financial markets and key asset classes today. This market presentation will cover three broad themes. Firstly, a market review. Secondly, an update on the economy. And thirdly, our outlook on key asset classes moving forward. Starting with the markets, if we think back to 2019, uncertainty dominated headlines. The trade war, uncertainty around Fed policy, an inverted yield curve, global growth concerns, and concerns around an imminent near-term recession all dominated headlines. In fact, if you looked only at the headlines, you'd think it was a terrible year for stocks. However, the complete opposite occurred. All asset classes were soundly positive across the board and really capped a very strong decade where global stocks more than doubled over that time period. In 2019, stock price appreciation was primarily driven by multiple expansion. And as a result, stocks ended the year at relatively elevated or stretched valuations relative to historic averages. Growth stocks in particular are now trading at the most expensive levels across every metric relative to value stocks since the dot-com bubble. At the same time, international and emerging markets appear relatively cheap to US stocks and may actually be better positioned to benefit from any improvement in the global growth or global trade narrative, given that those international and emerging market economies are much more dominated by global trade as a key driver of their economic growth. Turning to the economy, we are now in the 11th year of the current expansion, and this is actually the longest expansion since the Civil War. Our base case is for no near-term recession on the horizon, and for a 2-2-2 environment moving forward, meaning 2% growth, 2% inflation, and approximately 2% bond yields. Economic fundamentals remain robust with a healthy consumer and improvements in the trade narrative likely to increase business spending. A lot of businesses have held off on key projects just awaiting clarity around the trade war. In addition, we think that the housing market may actually positively contribute to GDP moving forward as well. Headline risks may increase ahead of the election, but we do think that those political risks or political headlines may be overstated given the likelihood of a divided Congress, where, in short, it may be that gridlock continues within Washington and no substantial legislation occurs as a result. Lastly, in contrast to 2019, where Fed policy gained a lot of headline attention, we believe that Fed policy is largely going to be a non-event this year, with rates on hold for the foreseeable future. So with that backdrop, what's our outlook for key asset classes? Well, for stocks, we are cautiously optimistic and do expect some moderation in returns moving forward, given the current valuations at this point in time and the very strong run that stocks have had not only in 2019, but over the last decade. Simply put, we don't expect the same level of returns in the next 10 years that we experienced in the last 10 years. Upside potential may, however, be found in international and emerging markets on the back of improvements in the trade narrative. Turning to fixed income, we do anticipate a lower for longer interest rate environment and coupon clipping across most of fixed income. Enhanced return potential and yield potential may actually be found in less liquid opportunities, which I'll speak to further in the presentation. Ultimately, we believe our portfolios are well positioned for the forthcoming period. So with this global backdrop, what are the actions that we're currently taking? Well, we continue to favor a globally diversified allocation to equities. International and emerging market equities are relatively cheap versus US equities, where valuations are somewhat stretched right now. And international and emerging markets may particularly benefit from the ongoing improvements in the global trade narrative, given that those economies are much more reliant on global trade as a key driver of their economic growth. Given the macroeconomic backdrop, we are actively managing our core fixed income allocations. We believe dedicated allocations to both satellite fixed income and less liquid investment opportunities, such as direct credit, may provide increased yield and total return potential moving forward. Stay diversified within portfolio allocations. We believe that our disciplined long-term approach to portfolio construction and rebalancing may help alleviate any future market volatility and add value over time. We do believe our portfolios are well positioned for the forthcoming period and offer a globally diversified portfolio that may help weather the potential for a lower for longer interest rate environment and the ever-changing geopolitical and macroeconomic landscape. After a weak end to 2008 in the fourth quarter, uncertainty dominated headlines in 2019. Fears around the trade war, global growth concerns, Brexit, an inverted yield curve, near-term recession risks, impeachment concerns. All of these dominated headlines throughout the year. And if you solely looked at those headlines, you would think that 2019 was a terrible year for the stock market, when in fact the opposite was actually true, as the market came to realize that a near-term recession was unlikely, the Fed became much more accommodative, and a trade resolution with China was on the horizon. In fact, the S&P 500 had its best annual performance since 2013. It was also a bull market in everything. Every asset class, every major asset class soundly outperformed cash in 2019. In fact, there are only two other periods in the last 100 years that's been the case. The recovery post the great financial crisis of 2008 and after the Great Depression. Now, if we look back to the past decade, global stocks have more than doubled in value from 2010 through the end of 2019. And over this period, the stock market has shrugged off a lot of uncertainties. Not only those that we discussed in 2019 most recently, but looking back, there was a US credit rating downgrade, unheard of, a European debt crisis to deal with, negative interest rates globally and an inverted yield curve, the ongoing Brexit issues, slowing global growth, natural disasters both in the US and abroad, trade wars and geopolitical turmoil, both in North Korea, most recently in Hong Kong, and the Middle East. But the point here is the reality is that uncertainties are always present, and it only underscores the importance of staying the course, of investing in a well-diversified global portfolio that can help weather the storm over extended periods of time. So what drove stock returns in 2019? Simply put, increased valuations or expanded multiples drove more than 90% of global stock market appreciation, as depicted in this chart here on the far left-hand side. 92% of the stock appreciation was driven by multiple expansion or expanding PE multiples, for instance. And as a result, you can see that now the stock market, the S&P 500 here depicted in this chart, its price to earnings multiple over time is currently stretched at a little north of 18 times versus the 25-year average of just north of 16 times. We are starting from a more expensive level to begin this decade versus 10 years ago. And as a result, we simply don't expect the same level of returns over the next 10 years, given that we are just starting at a higher level to begin with. We are witnessing currently elevated valuation metrics across multiple different metrics here, as depicted in this chart on this slide. And ultimately, given where we are with the valuation of the S&P 500, we really do anticipate a moderation in return expectations moving forward. We're simply not going to get those double-digit expected return profile that we witnessed over the last 10 years, or most recently in 2019, over the next 10-year period. Our base case is for more mid-single-digit return expectations moving forward. And given the fact that we are at an elevated valuation level currently, we just don't think that multiple expansion can drive sustainable stock market appreciation moving forward. We think at this point in time, earnings are likely to be the key driver of stock price appreciation over the coming time period. So if we look at the expectations for earnings growth going forward, well, the base case and general consensus expectation for the S&P 500 is in the mid-single-digit earnings growth range. Turning to growth versus value stocks, this has been in the headlines recently somewhat, and it's interesting. Growth stocks currently are the most expensive across every single metric relative to value stocks since the dot-com bubble. You can see that depicted in this chart here quite clearly, the most expensive level since the dot-com bubble on the chart there. So we believe going forward, the likelihood of a reversion from these elevated growth versus value relative levels is quite high. We simply don't expect growth stocks to outperform value stocks in the next 10-year period. They simply can't get that much more expensive than they currently are. And should value stocks outperform growth stocks moving forward, it may particularly benefit our allocations to dimensional funds, which do have an inherent tilt towards value over growth, given the long-term empirical evidence supporting value outperformance relative to growth stocks. Lastly, international and emerging market equities do appear relatively cheap to US stocks. You'll see in this chart here, the current price to earnings multiple as a percentage of the S&P 500 for international stocks is running around 78%. Contrast that to the 20-year average of 88%. So on a relative basis, international and emerging markets are cheap relative to US equities. Importantly as well, international and emerging market stocks may benefit more than US stocks as we gain clarity around global trade. and trade concerns abate. Given that global trade does drive a larger part of many international economies relative to the US. On a global scale, the US is actually a relatively closed economy, whereas most international and emerging markets their economies are really driven to a large degree by global trade. International and emerging markets do trade at discounts to US stocks. And if we do see a more positive trade narrative and a thawing in trade tensions, which we do anticipate and have witnessed most recently, this could spur international growth higher than anticipated and in turn drive increased earnings potential. Turning to the economy, we are now in the longest economic expansion since the Civil War. We've already entered the 11th year of this current expansion. And our base case is for no near-term recession. Simply put, fundamentals do remain relatively sound. We don't anticipate gangbuster growth, but we don't, at the same time, anticipate a recession occurring anytime soon. We anticipate positive but slow growth, again, a 2-2-2 environment, 2% growth, 2% inflation, 2% yields. Very well contained, slow, gradual, ongoing growth and ongoing expansion going forward. I'll speak to the reasons why in a second. Through the third quarter of 2019, which is the latest data point that we have, the economy was tracking at 2.1% growth. And again, we believe that it's likely that the economy will maintain a similar pace throughout 2020. In 2019, we had pretty strong consumer spending that was driven to a large degree by the tax cuts, benefits from the tax cuts. But at the same time, though, that stronger consumer spending was offset by weaker investment spending, mainly as a function of concerns surrounding the trade war and businesses holding back on projects that they would have otherwise moved forward with, awaiting clarity around the trade war situation. So going forward, now that we do have some clarity and some thawing in those trade tensions, we do anticipate, and we've already seen it in some of the data, that manufacturing is likely to rebound moving forward. And we believe the consumer remains strong, and there are some very positive fundamentals underpinning the consumer moving forward, which I'll speak to in a second. In terms of trade and trade uncertainties, it is important in that the trade war narrative really was the primary driver of the global slowdown in growth that we experienced through 2019. And you can see that depicted in this chart here at the onset of the initial tariffs, and then every economic metric that's shown on this chart clearly declines after that point in time. And that's really a result of business investment or businesses holding back on their capital expenditure, awaiting clarity around that global trade uncertainty. I mean, the worst thing for businesses is uncertainty and not knowing, the rules of global trade and whether or not they change overnight. Not knowing that just prevents and precludes a lot of investment being made into large-scale projects. But now that we do have greater clarity and businesses know the rules of the road, we believe we may see an increase in business spending, and as a result, another economic stimulus is that cash that has been sitting awaiting clarity is unleashed. That cash that's been sitting on the sidelines may be put to work, which we believe will be a positive for not only the US, but the global economy broadly. And in particular, speaking to the global economy, international and emerging markets may particularly benefit, given that those economies are driven to a larger degree by global trade. Turning to the consumer remains healthy across many, many metrics. And this is really important because almost 70% of US GDP is driven by consumer spending. So it's a very critical factor in overall GDP growth moving forward. But as you can see, household debt service level in the top left-hand chart here, it's actually at the most healthy level or lowest percentage in over 30 years. Household net worth is at all-time highs, and consumer sentiment is elevated while dipping in 2019 somewhat. It's bounced back, but still at nice elevated levels. And the labor market is extremely strong. We've got an unemployment rate that is running at, and as of November of 2019, running at 3.5%. And importantly, we are now seeing an uptick in wage price appreciation or wage price inflation as depicted by the blue line in this chart here. And what that means is that ultimately means that there's more money in the pockets of consumers, more money for those consumers to go out and spend. In terms of any potential concerns, we really don't see any major red flags with the economy. If we look at some of the critical cyclical sectors, residential investment, motor vehicles and parts consumption, business fixed income investment, change in private inventories, all of these cyclical metrics are very well contained. There simply is a lack of excess in any of these metrics. And put simply, you cannot have a bust without a boom. So, you know, we are following a lot of various economic metrics. We simply don't see any red flags currently. Turning to housing, we actually think housing may contribute positively moving forward. We're actually at a point now where the excess homes that were built before the financial crisis in 2008 have finally been absorbed into the economy. We have a much more favorable supply-demand dynamic now affecting home prices. Housing vacancy and inventories are at their lowest levels since the year 2000, while at the same time, household formations are increasing, driving up demand. And so ultimately, we think that the supply-demand dynamic not only should increase investment into housing, but also drive house price appreciation forward over the coming years, and may ultimately contribute positively not only to the wealth effect, but the broad economy. Another area for potential concern, and something that's been in the headlines recently, is outstanding debt levels. Corporate debt levels are at historic highs on an absolute basis, and that's caught some headline attention. But I think that the headlines really focus on the wrong metric. Having a low interest rate environment really leads to an increase in absolute debt levels. It's a natural response to those low interest rates. The more important metric to focus on is a company's ability to service that debt. I mean, if you think about it, say maybe 10, 12 years ago, a company could have borrowed at 6% interest. Now they can borrow at 3% interest. Well, essentially you could double the amount of debt outstanding and still pay the same interest cost. Now, obviously, companies haven't doubled their debt outstanding across the board, but you get the example there. And so what we believe that the ability of companies to service their debt is the much more relevant metric to focus on. And you can see in this chart here, based on interest coverage ratios, and this is specific to the high yield market, an area that has had a lot of focus because the absolute debt outstanding has increased over time, and without a doubt that has happened. But the reality is the ability of those companies to service their debt is in line with historic averages or historic norms. We just don't see any any cracks or red flags specific to outstanding debt currently. That being said, we do expect a marginal increase in defaults from the very low rate of defaults that we've experienced recently. But overall, the broad economy is still relatively sound, and we just don't see any major cracks in the economy or major increases in defaults moving forward. Turning to the election this year, political risks have obviously increased with the ongoing impeachment proceedings currently and the forthcoming election. Washington is clearly divided over many critical issues, so uncertainty surrounding the results of this year's election may increase or elevate market volatility as that election approaches. However, we do think that those political risks may be overstated, given the likely reality that we will find ourselves in an ongoing divided Congress. And that's important because the most substantial legislation occurs when you have a united Congress and White House. It's when you get the most political risks. Things change more dramatically when there's a united Congress and White House. In contrast, the most likely outcome is an ongoing divided Congress, with Democrats continuing to maintain control of the House and Republicans maintaining control of the Senate. So what's the impact of an election on stock market returns or the makeup of government more particularly? Well, the stock market has historically actually experienced higher median returns during periods of divided government. Again, less political risks under a divided government. Nothing substantial really gets done. A lot of gridlock in Washington, ongoing gridlock, may be experienced in the forthcoming years as well, despite the outcome of the election. Now, notwithstanding, headline political risks may increase the volatility, market volatility ahead of the election. And so it does really underscore the importance of maintaining a well-constructed, globally diversified investment portfolio that can weather and help alleviate any potential increases in volatility. Turning to Fed policy. Unlike 2019, when Fed policy really did dominate the headlines to a large degree, we anticipate that Fed policy will largely be a non-event in 2020. We think that the Fed is very likely to stay on hold and really sit on their hands throughout 2020. A big part of that is it is an election year, and they don't want to be seen as influencing this year's election one way or another. And to that point, we believe they front-ran their monetary policy in 2019. They probably made one or two additional cuts that they otherwise may have postponed to 2020 in 2019. And the reality is inflation is not a near-term concern. Inflation is still well contained in the 2% or sub 2% level. And the base case is a continuation of relatively positive but contained economic growth. Again, a 2-2-2 environment, 2% growth, 2% inflation, and 2% bond yields. And in that type of environment, it's unlikely that the Fed is really going to do anything substantial. So turning to the global growth outlook, you can see it's depicted in this chart here. We actually believe there may be some potential upside to these numbers, in particular development and as well as emerging markets, if we do see another round of economic stimulus in the form of increased capital expenditure coming into the global economy as a function of more clarity surrounding global trade. But what this chart really does depict is that there is likely to be a very wide disparity between developed markets and emerging market growth potential. And particularly emerging markets are likely to benefit to a larger degree because of because of more clear global trade policy going forward. So what's our outlook, given this backdrop, for asset classes moving forward? Well, as we said earlier, we are cautiously optimistic on the outlook for stocks, and we do expect a moderation in returns relative to those that have been experienced in 2019 and in the past decade. Simply put, we do not expect the same level of returns in the next 10 years that we experienced in the last 10 years. Our base case anticipation is for mid-single-digit expected returns for stocks. Though we do believe that international and emerging market stocks may have more upside potential, given that they are relatively cheap to US stocks and may particularly benefit from global trade clarity. Turning to fixed income, with the backdrop of lower for longer interest rates, we anticipate that the core fixed income component within our portfolios will have relatively contained total return moving forward. It's likely to be a coupon clipping environment of, call it plus or minus 3%, which is approximately the yield on our current core fixed income within our portfolios. Now, that being said, we do consider core fixed income to be an important anchor of the overall portfolio. This core is really what helps alleviate market volatility when stocks sell off. The core component, or core fixed income component, historically at least, has been the ballast which offsets some of that stock market decline. And to that point, it's an important component that allows us to follow our disciplined approach to rebalancing periodically. And when stocks sell off, we can take advantage of strength in core fixed income to sell down that position and buy into certain asset classes that may be relatively cheap at that point in time. We believe enhanced return potential may be found in what we like to call smart risk allocations, such as direct credit and direct real estate. These asset classes may offer equity-like return potential, or going forward even enhanced equity-like returns with lower risk profiles than public equities. Also, dedicated allocations to both satellite fixed income and direct credit may offer enhanced yield and return potential. Ultimately, we believe our portfolios are well positioned for the forthcoming period. Thank you very much for listening to this presentation today. If you have any questions at all, please don't hesitate to contact your client advisor.